You can continue to relax as I speak to you, and each time you exhale, you can feel yourself becoming more and more relaxed.
Yes, relaxation is indeed a worthwhile goal for your health and overall quality of life. But the question becomes, is it an achievable goal when it comes to money, especially with the financial markets still hitting record levels of volatility? With the right perspective and the right strategy, the answer is yes, as you're about to learn on today's show. It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. I'm David Scranton. 2 weeks ago, we took a close look at the record levels of volatility that have been rocking the stock market for much of 2018. Question becomes, is it all leading up to our third major market correction since the year 2000, the one that I've been talking about now on this show for 2 years? Well, for investors over the age of 50, that question is extremely important. But it also has the potential to be completely irrelevant, provided you have retirement goals that can be achieved with a defensive income-based strategy. And the good news is that most Americans do have those kinds of goals. And today we're going to discuss how to achieve them while also achieving another important goal, and that is the ability to relax amid today's ongoing market turmoil. And joining us will be renowned market expert Bill Johnson and financial advisor Matthew Johnson. But first, let's recap some important points that investors should understand about volatility still rocking the markets. As we pointed out last time we discussed this issue, the volatility we've seen in the stock market this year goes well beyond the norm. With the year still a month away from being over, 5 of the 10 largest single-day point declines in the history of the Dow Jones Industrial Average have occurred, you guessed it, in 2018, this year. October saw the Dow hit its highest number of losing days since 2008, while both the NASDAQ and the S&P 500 were in correction territory for at least part of the month. And the extreme turbulence has continued throughout November. The week before Thanksgiving, both the Dow and NASDAQ posted a weekly decline of 2.2%, while the S&P 500 fell by 1.6%. The selling continued into the following week, driven by a variety of factors, including a gloomy new report about home builder confidence. At the same time, a new survey from the trade publication Chief Executive found that CEO confidence in business conditions for the next 12 months is also at a new low. Many of the drivers behind all this waning confidence and consequently the turbulent stock market are the same issues we've been discussing on this show all year. Concern over the Fed's decisions on interest rates, the possibility of inflation, and especially potential impacts from the ongoing trade war with China. You can also include new worries over the recent midterm elections and what Democratic control of the House might mean for the president's economic agenda and his administration overall. A host of geopolitical uncertainties abroad are also increasingly impacting the markets here at home. One of the main ones is the implications of Brexit, now that Prime Minister Theresa May has laid out her plan for attempting to exit the EU, hopefully without causing global financial chaos. The bottom line is simple, that the markets are driven primarily by two emotions, fear and greed. And right now we're seeing fear progressively become the dominant force. How long will that continue? And how bad can things get? Well, no one knows for sure, of course, but the business community has become more pessimistic. Remember, it was only last year that business leaders were so optimistic about the Trump administration's tax cuts that the market set records for low volatility. A recent survey of the CNBC Global CFO Council found that just over half of its members believe the Dow will fall below 23,000 before it ever surpasses the 27,000 milestone that it briefly flirted with just a few months ago. In February, when the current volatility first started, only 42% of CFOs on the same council said they believed the drop below 23,000 was even possible. Today, only 13% of them, only 13% believe that the market will reach a new record high before the next major drop. Now, of course, as we discussed at length on last week's show on a very similar topic, that major drop is already well overdue according to the lessons of stock market history. Now, if not for the unprecedented levels of artificial stimuli undertaken by the Federal Reserve and central banks around the world in the past decade, another major market correction most likely would have begun around 2013 or 2014. That's when the market actually returned to its previous peak from before the 2007 to 2009 correction. If allowed to function normally, it probably would have taken another drop in keeping with all the long-term secular bear markets throughout history, which typically experience at least 3 major market corrections. And remember, this long-term secular bear cycle began with the 2000 to 2003 market drop when the tech bubble burst of it almost 50%. It progressed normally with that second drop starting in 2007 and going right into 2008. But that's when the Fed's reckless overuse of quantitative easing and other forms of artificial stimulus began. What we've been seeing since then has been anything but normal. And that's what makes forecasting where the markets might be headed now even more challenging than usual. It's like trying to predict whether an athlete pumped up on anabolic steroids is going to continue to perform at an artificially high level or finally succumb to one of the many risks associated with steroids. That analogy is a great one for everyday investors to think about when considering their options in this volatile stock market. We'll talk more about that in just a bit. But now it's time to welcome our first guest, Bill Johnson. Bill Johnson is a renowned market expert who has published 10 books on various financial topics, including options trading, single stock futures, and the Federal Reserve. He's the founder of OptionsAtoZ.com, a website dedicated to teaching the art and science of options trading, and he teaches financial risk management as an adjunct professor at Florida International University. Bill, welcome to the show.
David, thank you for having me. Great to be here.
So, you know, it's funny. We were sitting here just 3 months ago, a little bit more, in the month of August, and things were calm. And I don't know whether all of Wall Street was on vacation or asleep or what was going on. Volatility was really low, the VIX was really low, and all of a sudden, bam, here it goes. What's your overall take on the more recent market volatility that we've seen so far?
Yeah, there's no question. Everything was going along smoothly. Then October 2nd hit, and it all just broke loose. But, you know, market volatility plays a role that it is creating enough risk to induce investors to take those investments. But whenever you're starting to look at fear and the downside, that's when people panic, and you're going to see those spikes in the VIX. Always happens, but they always come back down to that long-term average.
So I know as an options trader, you paid more attention to the VIX than I do or most financial advisors do. What do you think's causing this volatility? What would you say is the major driver right now, or are there more than one?
Well, I think there's always more than one, but for sure it's going to be the key headlines that we're seeing: trade wars, political uncertainty as to what's going to happen. And that's always going to throw up big question marks for investors. What's going to happen to my investments? And so when that happens, people are going to sell off until it gets to a level where people are willing to take the other side. So I think it's just very simply just fear. I would have to say it's primarily trade deficits. The trade wars is the primary driver.
Now, it's interesting. I'd like to hear your take on it. I've had people on the show that have said that we can win a trade war. We're winning it right now, as evidenced by the fact that our markets are down a little, but markets in China, stock markets in China, for example, are down a lot. Our
Sure.
GDP has gone up this year, whereas China's GDP, although it's still higher than ours on paper, has come down. So what do you think? Who's going to turn out on top? Is this just a fear and eventually we're going to be fine? Or do you think we might get the short end of the stick with the trade war?
Good question. It depends on how you want to define the term win. Can we come out and kind of arm wrestle China into the ground? It's a possibility. But trade wars or quotas or tariffs, that nobody wins in those. And that's why historically they almost always break down. With a tariff, you are going to get the more revenues for the government, but there's always what's called a deadweight loss to society. Overall, there's a net loss. And so I think in the long run, nobody really ever wins those.
Now, it's interesting. Up until just this past week, I was concerned, my biggest personal concern, and perhaps it still is that the Federal Reserve will create the next recession and will create the next bear market in the stock market. Of course, as you know, Jerome Powell came out just over the last week and got just a little bit more dovish in his tone, which the markets seem to like. How much do you think the markets are concerned about that versus China, for example?
I think it's probably carrying about equal weight. I said the trade wars were probably primary, but not far behind is the whole thing on inflation. And so, yeah, I mean, the market certainly responded well on Friday, a little more of a dovish tone. And I think they kind of had to. There's been a lot of talk about in the Fed. There's been a lot of bashing by President Trump. And even though they are theoretically independent of the president, you have to think there's still some political bias there for them to say we really can't be saying we're going to hike up interest rates here and cause turmoil in the markets.
So in the 20 seconds we have left in this segment, tell us, what's your best guess? You know, we're going to see one more interest rate bump in this month in December. How about next year? 1, 2, or 3 by the Federal Reserve? What's your best guess?
Oh, that's a tough one. Of course, now they've come out and said which is a good policy that they're going to look at it on as the case-by-case basis as the information comes in. I would be surprised if we're going to see more than 2.
Okay. Well, we need to go to commercial break right now. Stay with us, Bill, please. And you stay with us, too. We'll be back with more here on The Income Generation. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
And there was a big debate for many years. The American Medical Association for years said it did nothing. Well, the athletes knew better. It clearly does work, but it is clearly dangerous. And the side effects can be in the short term, the long term. Some are predictable, some are not predictable.
That is Gary Wadler from the World Anti-Doping Agency talking about the dangers of anabolic steroids. For several years now, I've been using the analogy of steroid use to explain the performance of the stock market. It's a really fitting analogy because when an athlete takes anabolic steroids, the goal is to artificially enhance his performance. And very often the steroids can do just that. In very much the same way, the excessive use of quantitative easing and other forms of economic stimuli following the financial crisis have indeed worked to artificially enhance the performance of the stock market. As you may recall, 4 rounds of quantitative easing over 6 years gave way to finally quantitative easing tapering. And that led to the current efforts to really completely unwind all the stimulus by selling back trillions of dollars in U.S. Treasuries purchased by the Federal Reserve back to the average investor. In the meantime, other struggling countries around the world have launched quantitative easing efforts of their own, making this artificial enhancement even more widespread and more systemic. Essentially, the stock market has become addicted to artificial stimuli in the same way an athlete can become addicted to anabolic steroids, eventually to the point where he no longer knows what his true abilities really are without them. Basically, I believe that's the point that we're at now with the stock market. Consider, for example, that the S&P 500 is up an incredible 277% from the low point of the last major market correction in 2009. Meanwhile, GDP growth hovered at or below a mere 2% for most of those years, never really topping 3% until just this year when it hit 3.5% for the third quarter and 4.2% for the second quarter in the wake of the Trump tax cut. But even at that rate, there remains a huge and glaring disconnect between economic realities and market performance thanks to the overuse of artificial stimuli. In fact, much of the extreme volatility we've been experiencing this year may be a sign that the steroids are finally wearing off and the markets are being forced to function normally again. Functioning normally means responding to all the fears and uncertainties we discussed at the top of the show, and ultimately making fundamental sense again. That may just mean finally giving way to that third major correction that I believe should have been here maybe 4 or 5 years ago, and probably would have been here if it hadn't been for all this artificial stimuli. But one of the overriding characteristics of steroids is that they're unpredictable. They affect different people in different ways. By the same token, the ultimate impacts of all the artificial stimuli pumped into the economy these past 10 years are impossible to predict. They simply cannot be forecast with any certainty. Why? Because all of this is really completely unprecedented. There is simply no historic model to go by, and basically it's all been one huge economic laboratory experiment. What that means is that there is a slight possibility that this might just turn out, slight possibility again, that it might turn out to be the first long-term secular bear market cycle in history to actually end without a third major market correction inside of it. But the question you should be considering is it probable? And the answer is clearly no. But is it possible in the wake of these unprecedented levels of artificial manipulation? Sure, it's possible. Anything's possible. But here's why I believe that steroid analogy is a good one for any investors over the age of 50, members of the income generation, to think about and consider when pondering your financial options in the midst of all this uncertainty. Ask yourself, if you joined the gym with a particular fitness goal in mind, would you immediately start taking anabolic steroids to help you achieve that goal? Now, what if you knew that 2% of the people in the gym were already taking steroids? What if you had a friend in his 70s who had been taking steroids for 50 years and was still going strong with really no adverse effects? Well, I'm guessing that your answer would still most likely be no. Why? For one simple reason. Despite these exceptions, you know that the odds are still against you. You know that anytime you're dealing with something artificial and unpredictable, you're taking a huge risk. Well, that same idea applies when talking about an unpredictable and artificially enhanced stock market. And it's not just a risk. It's an unnecessary risk. Why? Because there are other safer ways to achieve your goals in a market like this. We'll talk more about that in just a bit. Right now it's time to welcome back Bill Johnson. So, okay.
Thanks, David.
We might get a couple of rate hikes next year. That'll put short-term interest rates right up about 3%. But the question is, will the long-term end of the yield curve continue to go up? You know, so far the Fed's been able to just jawbone and get the long end of the yield curve to go up, getting the bond market to sell off when appropriate and react accordingly. But will that continue? A lot of the world is still easing quantitatively. A lot of the world is not doing as well economically as our GDP numbers seem to be indicating. So what are the chances we get up to 3% on the short-term rates and we get a yield curve that's even flatter than it is today? And how big of a concern should that be for investors?
Well, the flattening or certainly an inverted yield curve is usually a sign of inflationary fears. And I don't think that that's going to happen. I think we will probably start seeing some steepening of that. Like you said, we're probably going to look for about 3% on the short term. Usually 5 or 6% is considered moderate interest rates, which is one of the mandates of the Fed. So we're probably going to see them eventually work up into those ranges, and I think you'll see that long end just out of risk-reward relationships end up bumping up.
5 or 6% where? On federal funds rates, on short-term rates, or longer term?
More short-term rates.
Wow. Do you think they're really going to be able to go that far?
No, and nothing in the short term. I'm just saying it's more of a long-term kind of historic. So we still have room, and I know we've been talking about rates, going up, and that seems to be a concern, but we're still really historically low. So I'm just saying that there is definitely room for them to rise.
And of course, as you know, that creates a problem for our own beloved federal government because the federal deficit is growing. And of course, the president loves to say that if we can maintain 4% or even 3.5% GDP growth, then we should be able to really spend our way out of this, spend our way out of the deficit. Right. Are you a fan of that, or do you think that ultimately we need to get spending in order? Or can we spend our way out of it if we keep GDP at least 3% per year?
Well, the thing about spending our way out of it, I'm assuming you mean by GDP or just by taxing?
By GDP.
By GDP, you can, but it's a big deficit. And I think the bigger concern is that you hear a lot of people saying we have to pay this down. And that really is a policy, doesn't necessarily by itself make a lot of sense because it all revolves around government spending. Because every time we pay down the deficit, we're really reducing savings. So it doesn't make sense to deplete the savings to go back towards more wanton spending. I think it all has to start with control in Washington.
And think about if long-term rates do get back, forget about short-term, let's say long-term rates get back to that 5 or 6% marker. What that'll do to the government's cost to carry on their debt. In the 10 seconds we have left in this block, what are your thoughts on that? Is that something we really need to be concerned about?
No, that's a big myth. The cost of the debt cancels itself because if the government raises your taxes by $10, then that's a $10 extra you have in your savings that can obviously earn the T-bill rate. So those exactly cancel. So the interest on the debt is never really a concern, and that's really why the deficit is usually grossly
So we need to take another commercial break. We need to leave it there for now. Stay with us. We'll be right back here on The Income Generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Just a few months back, we devoted an entire episode of the show to the subject of bond bubbles. Now, if you caught that episode, you'll recall I explained that the whole concept of a so-called bursting bond bubble is often used as a scare tactic for investors. Analysts and advisors who specialize in stock market-based financial strategies sometimes use the term to try to sway people away from bonds and to keep them focused on stocks and stock funds. Why? Because doing so often suits their business model as a financial advisor. The term is largely hype. However, because historically, the bond market simply doesn't burst in the same way that the stock market can crash. Changes in the bond market are more gradual, and volatility is typically much less dramatic or much less extreme than it is in the stock market. And this year has been a perfect example. As the stock market has experienced record levels of volatility, the bond market has also been more active in response to fluctuating long-term interest rates. In May, the yield on the 10-year Treasury rate topped 3% for the first time in 5 years. Since then, rates have fluctuated between a low on the 10-year Treasury of 2.77 and a high of 3.23. As most people know, generally speaking, when interest rates go up, bond values go down and vice versa. But as I've noted several times before on this show, that is an extreme oversimplification of how bonds work. In truth, many other factors impact bond values. Now that's important to keep in mind whenever you hear an advisor or analyst parroting another falsehood typically used as a scare tactic, that bonds are always a bad investment in a low interest rate environment. Obviously, that's based on the oversimplified formula about this inverse relationship between bond values and interest rates. But it not only ignores the fact that bond values have many other influences, but it's also largely irrelevant when talking about strategic investment in individual bonds and bond-like instruments. As I've explained before, there's a huge difference between the bond mutual funds that you're probably used to investing in with a stock-based financial advisor and the individual bonds offered by an advisor who specializes in the universe of income-based strategies. You see, individual bonds typically come with two important guarantees that you don't get with bond funds. And these guarantees are contractual. First of all, that income generated is going to be at a fixed rate and is going to be for the life of the bond. And secondarily, that the return of your principal investment will occur at maturity, provided that you hold the bond to maturity, and of course, assuming there's no defaults. Now, if you're a regular viewer, you probably heard me explain all this before. But I'm sharing it again to illustrate the point that I made at the very top of the show, that even in the midst of the record volatility we're experiencing in the stock market, fluctuating interest rates, and new age of economic uncertainty, it is possible to achieve peace of mind and a higher level of relaxation where your finances are concerned. Investing for income makes that possible because it's actually the opposite of taking a risk on an artificially inflated stock market. It's as real as a financial strategy can get. Why? Because again, most of it is contract-based. You really don't have to worry about whether extreme volatility is a lead-in to the next major market drop, or even about potential headwinds in the bond market causing rising interest rates. Why? Because with this contract between you and the bond issuer, any loss of value in an investment is only a temporary paper loss, assuming you hold that bond to maturity, and once again, of course, assuming there's no defaults. Plus, it does not, repeat, does not negatively affect the thing that you primarily invested for, and that is a steady income rate. Your income doesn't change and your initial investment is secure, meaning all the volatility and uncertainty are things that you don't really even have to think about. Another good analogy for this type of strategic contract-based investing is in the real estate world. So let's say, for example, that you buy a property worth $200,000 and you sign a lease with a tenant, a long-term lease that guarantees you $1,000 a month in rental income. Now let's say that the value of the property drops from $200,000 to $180,000, for example. You've got a long-term lease, so you're still getting your $12,000 a year of income. Do you really care that the property dropped in value by $20,000 if your income stays the same? Probably not. Plus, the property's loss in value is really only a paper loss as far as you're concerned, and probably only temporary based upon fluctuations in the real estate market. Now, let's take that example a step further. Let's say that you buy this property, and this time the tenant signs a long-term lease to pay $1,000 a month in income, but also to purchase the property 10 or 20 years down the road at the initial purchase price that you paid for it. Now you've got reliable income at a fixed rate for the life of the lease, plus a guaranteed return of your initial investment at some point down the road. That is essentially what you're getting with an income-based investment strategy. And for most people, that's a strategy that suits their goals. We'll talk more about this in just a bit. Right now it's time to welcome back Bill Johnson. Now, Bill, you just said something that was caught me a little bit by surprise. You said, okay, if you have, if the cost of carry for the U.S. government goes up and the interest rates on their debt goes up as bonds mature and come due and then get reissued, that ultimately it'll mean that there's more interest that investors earn on bonds, and that'll generate more tax dollars. So essentially those tax dollars could pay the extra interest. Except I think there's a couple other factors I'd like to ask you about. Number one, the tax dollars don't cover all of the interest because the tax rate's never 100%, right? It covers part of the interest. And number two, how about those bonds that are held overseas? When interest gets paid to somebody, the Chinese government, for example, that doesn't pay taxes here in the United States. What does that do?
Right.
How do they make up for that?
Well, first of all, unless I misinterpreted the question, the interest, I mean, you can earn with the government, the same rates. Normally in the markets, we can't. The amount that we pay for cars and credit cards and things isn't what we get at the banks. But you can certainly get the government borrowing rates by putting it into T-bills. So any type of interest on the debt is exactly created a mirror image benefit by keeping that same amount in your savings. So the interest on the deficit, it really should never be a concern.
It's a mirror image for the consumer, assuming they don't spend the money, correct? Assuming they take the money and they save it, invest it, and so on. But still, it's a net, you do agree it's still a net cost to the U.S. government at the end of the day, because even the taxes on that interest are not at a rate of 100%, correct?
I guess if you're looking at it from the tax issues, but I'm just talking about the interest component of it. So the interest component really is a wash. So to make a policy to say that we've got to pay down the deficit because of the interest on that is really an absolute myth. Those are going to cancel.
Okay.
But I think the size of the deficit is a different story. But you have to say then, is it a question of spending that we need by the government?
So in the 25 seconds we have left in this segment, tell us, bottom line, for our income generation members, those over the age of 50, what do they need to know about managing their money in a volatile environment like today?
Good question. Yeah, you've got to keep those positions hedged. You definitely need to, you don't want to let those portfolios grow and end up in another 2007, 2008 era and watch half of it get wiped out. So you definitely need to start keeping things hedged and change up those plans.
I guess we'll have to have you back on the show sometime so we can talk about how you can actually use options to hedge, your area of expertise. Thanks for joining us, Bill. And you come back, we'll be right here with more on the income generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Now, for some people, no ride at Six Flags is too big or too scary. Some people go to an amusement park with the express goal of testing themselves. They want the maximum adrenaline rush they can get, and they'll gladly jump on all the rides that give them that rush. But other people at the park have different goals. For them, it isn't really about thrills and adrenaline. Their goal is to enjoy the atmosphere and the less intense entertainment offerings. So with different goals, these different types of people spend their time at the park in different ways. Now that may seem obvious, but it underscores an aspect of retirement planning that many people often overlook or ignore: the importance of identifying your specific retirement goals. Now, this is another point that will sound familiar to regular viewers, but it's especially relevant when discussing the practical value of investing for income in a highly volatile market like the one we seem to be in today. In general, everyone wants basically the same thing when they go to an amusement park. They want to have a good time. By the same token, everyone wants basically the same thing from their investments. Everyone wants maximum return, and ideally, with minimum risk. But in both cases, it's necessary to take that basic goal a step further. In the case of investing, that means answering the question, maximum return for what eventual purpose? And I look at it as that there are three real options here. The first purpose is to leave an inheritance for heirs. The second is to have a lump sum purchase down the road, money for maybe to buy a yacht or a Rolls Royce. Or the third is for income, current or future. In my experience, over 90% of the people at or near retirement age have the same answer, and that is income, current or future. That is their primary goal. And that's why it's so important for everyone to understand that total return is really a sum of both growth and income, with growth coming in the form of capital appreciation and income being generated through interest and dividends. Now, if your specific goal beyond maximum return with minimum risk is to leave an inheritance or maybe to purchase a second home or a yacht or a Rolls Royce, then yes, it might make sense to focus your investment strategy on the G part of that formula, on growth and capital appreciation. Just as it would make sense for someone whose goal at Six Flags is pure thrills to test him or herself on all the most frightening rides. But for someone whose specific financial goal is usable income, then focusing on strategies designed to protect principal while generating reliable and consistent income obviously makes sense. It makes a lot more sense than focusing on growth. Growth might be the right approach for those few investors looking to build up a big inheritance or save for a major purchase, and maybe even in a highly volatile, artificially inflated market like today. But for the majority of investors who are interested in relaxing in retirement with a sense of calm and a sense of security, yes, there is a more practical, there is a more sensible option. And obviously, if your goals don't change during retirement, then neither should your overall strategy, regardless of market conditions. Now it's time to welcome our next guest, Matthew Johnson. Matthew is owner and president of Johnson Wealth and Income Management in Humboldt, Iowa, a third-generation company that's been serving clients for over 50 years. Matthew's been in the business himself since the late 1990s, and he works to educate clients on how to avoid losses and how to achieve their retirement goals using conservative, income-based financial strategies. A man after my own heart. Matthew, welcome to the show.
Thank you, David.
Of course, you and I go back quite a ways, and of course, my nickname for you, our viewers don't know this, we call you MJ. MJ.
That's right.
So Michael Jordan's not the real MJ, my buddy from Humboldt, Iowa is. But let's talk about volatility. You know, what are you seeing right now in the middle of the country when you talk to clients day in and day out about market volatility? Are they becoming more concerned over the last couple months with what they're seeing, or do they have the confidence that President Trump can fix everything?
No, not at all. I'm seeing a lot of cautiousness. I'm seeing a lot of nervousness. You know, in the beginning of this year, the Dow Jones dropped 11.6%, and then it took us months on end to dig ourselves back out of the hole. We thought we had basically no worries in October, and then all of a sudden, just in time to experience another 9% decline. And clients are really concerned about their money because they don't know if in the middle of the night there's going to be some tweet and they're going to wake up the next morning and now their accounts are down and they're going to have to make that tough decision. Do they hold off on, you know, going on that cruise because now they'd have to be selling shares at a low and taking a loss? So there's a lot of concern out there, and I think it's only getting greater and greater as far as the nervousness is concerned.
Wow, so you're certainly seeing this. So in 15 seconds or so, please tell us, you know, so are you seeing that people are coming to you more proactively now saying, hey, maybe I need to kick my risk down a notch, or are they just looking at you saying, I don't know what to do?
Well, absolutely. I think that there was there was always the bunch that were really optimistic and they thought that Trump was going to solve everything, but now they're starting to realize the effect of tariff and law and volatility in general.
Oh, makes sense, makes sense. MJ, we'll be back in a moment. You stay with us too. We'll be back with many more words of wisdom from my good friend Matthew Johnson. We'll be back on the Income Generation. Welcome back to the Income Generation. I'm David Scranton. I'm here with my good friend Matthew Johnson, aka MJ, financial advisor extraordinaire from Humboldt, Iowa. So Matthew, I promised I wouldn't dig too deep, but I want to talk a little bit. We dug deep on our last interview, but I want to talk to you a little bit about What do you think is the major driver right now making people nervous? Do you think it's the trade war? Do you think it's the Federal Reserve raising interest rates, political unrest? What are you hearing, grassroots, in your office when people come to see you that concerns them the most?
I think it's a combination of everything. I mean, wherever you look, there's volatility. We're not in a shortage of crises in any particular day, whether it's more tariff talk, whether it's raising interest rates, whether it's taking and looking at the nervousness of the stock market just based upon some politicians' comments. People realize that if they're in the stock market, they're not insulated, and they feel a little bit of helplessness because they realize that they really have no control over what takes place in Washington, but they understand that whatever politicians do, it's going to have a specific personal effect to their retirement savings.
So what are you telling people who come into your office with these concerns? What are you telling them to do if they're a member of the income generation, they're retired or maybe within 10 years of retirement?
So really it's pretty simple. If we want to have more income in retirement, and that's the goal, right? We want to have more income than we could ever spend, then doesn't it behoove us to try to reduce our risk? And here's the irony. When you focus on income generating investments, you naturally reduce your risk. And so if you want to have your principal making interest and dividend income that you can spend or income that you can save, income really is the key. Total return is always comprised of two components. Mm-hmm. Yes, growth is one of them, but income is the basis. That's the foundation. It's income plus growth.
Sure, sure. As you've heard us even talk about earlier on the show, absolutely. But I'm sure every once in a while you get somebody who walks in there and says, yeah, but wait a minute, interest rates are going up. Why would I want to buy bonds now? Isn't there going to be some bond bubble? The bond market's going to crash. That's what my broker told me. Sure. And you heard me talk about that a few minutes earlier in the show, a few minutes ago. But how do you answer that when a prospect says that to you? Because we know that's not as big of a concern as people think, but what do you say?
Well, it's all about buying right. You see, when you're a stock investor, you've got three things you've got to do. You got to buy it right, you got to hold it right, and you got to sell it right. And you have to make those three decisions right every single time, otherwise you don't make money. When interest rates go up, typically fixed income positions start coming down in price. And right now I show clients where that's like a Kmart blue light special. That's things going on sale. And if I can buy good quality positions at prices that are less today than they were a year ago, it makes more yield for them and more income.
Which you think about it, Matthew, is true. Whenever you buy something, buy real estate or whatever, the key isn't selling it right. The key is always buying it right, because you never know what's going to be down the road.
Exactly.
So we need to leave it there for now, Matthew. Thanks so much for being on the show once again. Look forward to having you back. I'd like to thank our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, of course, our new and returning viewers. As I've mentioned before, one of my passions outside the financial world is flying. I have my own airplane, and I'm also a licensed flight instructor. Each time I fly, I have to put a flight plan together. Now, as it turns out, my plane actually holds 301 gallons of fuel. But interestingly enough, 9 of those gallons are in the lines. So the tank contains 292 gallons of what's called usable fuel. So when I make my flight plan, how much fuel do you think I base the plan on? 301 or 292 gallons? Well, if you said 292, then you're correct. Essentially, that additional 9 gallons is completely unusable. So I don't factor it in at all into my plan. I know it's there, but for planning purposes, it's not relevant, so I don't think about it. In many ways, this is a great analogy for retirement planning. Say you have an old-fashioned defined benefit pension plan. You know, the type that had guaranteed monthly payouts for the rest of your life, no matter what. You know the plan has a certain lump sum value, but is that relevant to your retirement plan? Well, really, no. Why? Because with this type of pension, that lump sum is, by definition, unusable. Just like that extra 9 gallons of fuel in my airplane. The only thing relevant to your plan is the amount of income that pension generates year after year. Now, the same idea is also true with an actively managed, diversified portfolio of individual bonds and bond-like instruments. Why? because you know that if you spend your principal, then you'll lose income in the following years. So you're essentially choosing to designate the principal as unusable, much like the lump sum value in a pension. Yes, your bond's values may fluctuate based upon the direction of interest rates and other factors, but is that really relevant to your flight plan, meaning your retirement plan, if your goal is reliable, usable income? The answer is absolutely no, because you've designated the principal as being unusable anyway. And because of that, you know the investment will continue to generate the income you need to meet your retirement goals, regardless of market conditions. In other words, you'll know that you can relax, even in the midst of record market volatility and in the unprecedented age of economic uncertainty. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential you stay informed and up to date. And where can you do that? You guessed it, right here on The Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.